Hey, everybody. Thank you for joining again. Sorry about the double bill today. Hey, everybody. Thank you for joining again. Too much to share. And there's no way I could have packed it all into one quickie. It would have taken half an hour, which is against the rules of the quickie. So anyway, let's talk about the global macro update. There's been a lot of interest for those who really care about where the world is going and how they need to guarantee their financial future. It is very important to keep an eye on this stuff. There are a couple of things in this video that some may find very disappointing, very alarming, and I'm sorry in advance for that. So let's just jump in. This is a new topic, global macro update. I'll create a new playlist as well for those who are really just interested in macro, because at the end of the day, you have to have your eye on the macro bull to understand where your investments are going. So let's jump in. So first of all, now this is financial advice, but it's macro, so it doesn't really matter. But I have to say that anyway. And the story today, well, we're going to talk about oil, real wages, gaslighting, inflation, deals. So I can't even remember all the stuff. A bunch of numbers, winter heating, what's happening on Google. So a lot of interesting stuff, to say the least. Let's start with this. This is kind of an amazing victory in just 3 or 4 days. So the Inflation Reduction Act was passed last weekend. I think it was last Sunday. It was nearly $500 billion to reduce inflation. And 3 days later, Joe Biden, the President of the United States, declares victory. He said, our economy had 0% inflation in July, which is a huge win. So big thank you. That was the best spent, $500 billion ever to eliminate inflation almost overnight, which is very special. And I'm being a little bit sarcastic here, but that actually happened. What a crazy world in which we live. Now let's look at inflation real fast. This is, I've been talking about how we are beyond peak inflation. It's pretty obvious. Just look at oil and you get there. We'll talk more about oil in a minute. But here, when we look at the global macro situation, it looks like supply chains are kind of coming back into more of an orderly state, which is good. It looks like the era of C-19 lockdowns is over. The world is getting smart at last. It only took 2 years. 2.25 years. And that has changed the world forever. Also, commodities, including oil, are way off pandemic highs, sometimes even under in some cases. And the Federal Reserve, as I said, seems to be pivoting, hitting or laying off the monetary policy brakes. We don't know if that's exactly true, but that's my theory, and I'm sticking with it, ladies and gentlemen. And statistical quirks will tip the scales to lower inflation prints. That is, you're measuring against the past. In fact, all of these together, technically, with the way in which prices are coming down so fast, we could easily, theoretically, get back to 3 or 4% inflation by Christmas. And if things really slow down, like oil and energy prices, it could even be negative or deflationary. So that's why I say deflation next, but we'll see. Interesting to monitor. Now let's talk about oil. This is per the Financial Times, the largest oil and gas producers in the United States and US companies operating around the world decided to keep a lid on supply, defying calls from the Biden administration to lift output, even as soaring fuel prices driven by the Ukraine situation. Nobody is bending because the oil companies are making so much money. Why increase production? So they're kind of ignoring the president. Now, related to that, kind of interesting, Biden had a very hard-won meeting with the Saudis, and he did a fist bump with MBS here. I won't talk about him at all. I don't want to get political. But the OPEC decided to boost output of 100,000 barrels a day. And it may not only be the smallest on record, but it may also be the shortest, because per this Zero Hedge article, OPEC expects global oil markets to tip into surplus this quarter. Therefore, they are thinking about cutting already. So that wasn't a very successful visit. And for those who don't know, 100,000 barrels is, as I would say, a nothing burger, an extremely small amount of oil. So interesting. Let's look at the oil price chart. Why jack production when price is already tumbling? So here's my little oil chart. You've got my $100 level, the big blue line across the middle. I have the Feb 24th, the invasion date price, and we are right at that price right now. We went actually below it for about a week last week, and we are trading currently around $93 a barrel, far under the 200-day moving average and very far under the 50-day moving average, which again shows you exactly what has happened in a very short window of time. So let's talk more about a little bit related to energy, but this is kind of a staggering announcement. There's a word in German called Brennholz, which means firewood. Now, if you look at the Google search terms, you can see obviously kind of clear pattern over the last, say, 16, 17, 18 years. But all of a sudden, everybody in Germany is looking up the term firewood. So what does this spell, everybody? Energy problems. People are really concerned about the cost of gas, heating oil. I don't know if anybody uses heating oil anymore, but this is a problem, everybody, and people are beginning to try and plan for it. Fingers crossed. Thermal underwear, lots of warm clothes, insulate your windows, draft, cover your doors. Simple advice in cold climates. Now let's talk about emerging markets. This is from Charlie Bilello. Big thank you again to Sanjay for sharing this with me this morning. Now, this is really interesting. Again, the ratio of emerging markets to US stocks is at its lowest level since 2001. Over the last 12 years, emerging markets is up 28%, while US equities have more than quadrupled. Okay, 4x. So basically, emerging markets are lagging the S&P 500 by 329% over the last 13 years. So a lot of people believe emerging markets is the place to play. But according to this, the last 13 years, you would have lost a lot. Now, it doesn't mean that emerging markets are toast. They will come back with a vengeance, but I think we need China to stabilize first to get past all the property problems, open up more to technologies and public listing of companies in other markets around the world. Then it might be kind of more risk on for some of these names. So we'll be monitoring this carefully. But again, emerging markets, not the place to play over the last 13 years. But that doesn't disqualify it going forward. Watch this space. Now let's talk about Japan. Softbank, a huge fund. They were throwing money around like it was going out of fashion. Literally anybody with a term sheet was just outbid by Softbank because they were so big, they were just chasing deals. But they had the biggest loss in history. Softbank Group wrote off 3.2 trillion yen, which is about $24.5 billion in Q1 of this year. But again, a staggering loss. So things are not going very well for this Softbank company out of Japan. Let's switch gears and talk about the job market. I'm very opinionated in the job market. I was pretty hard on the jobs report. Everybody thought it was amazing. No, it's not, because it's people getting second and third jobs because they can't make enough money because inflation is crushing them. So with this, this shows you kind of, again, going back to the 70s and some of the differences. The green line is the unemployment rate and the yellow line is the employment level. APR growth, very important. And you can see a distinction. A lot of people say, oh, we're kind of like back in the 70s, but it's not, because there was a very different working age population as the baby boomer generation came of age in the 70s. And this is in direct contrast to today's essentially zero working age population growth. You get that? Zero working age population growth. This is one of the concerns that Elon Musk has. We are not having enough babies. Now, that's important because high population growth and younger averages are thought to be a driver of higher equilibrium real interest rates and the interest rate necessary to stabilize inflation. Therefore, rising population growth drives higher real output growth, which directly, through an increase in the number of workers, also accelerates the demands for capacity investment, house, clothe, feed, transport, etc., as we go forward. But now we have a weird situation where you can walk into any store like a Walmart in the United States and you will see people in their 70s back at work because they need to supplement their pensions. They don't have enough money by which to live or pay the rent. And these septuagenarians are now competing with the younger people for jobs, causing more, maybe potentially wage inflation. We'll talk about that as well. And I think it's heartbreaking to see people who've worked all their lives have to go back to work. Anyway, separate issue. So let's look at this. This could be a little bit of bad news. This is from Charlie Bilello. And it says basically all of the US wage growth since the start of the borrowing printing binge has been a mirage. Yes, wages appear to be up 13% in nominal terms, but they are actually down more than minus 1% at least after adjusting for higher prices. Initially, everybody loves the free money, but it's only with the passage of time you can see the ravages of inflation. So what does this all mean? They're getting paid more, but that, say, 13% increase in salaries over the last 2 years is far outpaced by the increase in food and energy and entertainment and travel, you name it, cars, houses, etc. So I put together a little bit of numbers. I did some digging from some publicly available data, and I analyzed, ignore the spreadsheet, I'll show you a simpler version of it in a second, a visual, but I analyzed the labor cost, output, and productivity going back 10 years. And here you can see the labor productivity is down 4.6% in the second quarter of 2022. Okay, but there's a whole bunch of others, but it's much easier just to look at this visual that I put together to give you a flavor of exactly what's going on. So here, more money, which is the yellow, the unit labor costs, the yellow line going up and down, has gone up. Then productivity, which is blue, is going down. And the actual output is red, is going down as well. So what does this tell me? It's like we're spending more, but the output is falling and productivity is falling. And this is over the last couple of quarters, and that is not a good situation at all. Again, it's all related to the fake, employment report. When you dig into numbers, you get the real truth. And this is the problem. But this is also related to other things. Maybe people are just upset. They're not happy working for kind of nominal wages anymore. Or, as I always say, C19 changed everything. People want better working conditions. They want more money. And they're just maybe frustrated and kind of not pushing as hard as they used to, working around the clock 7 days a week, like some people here. Anyway, let's look at this. This is another very, very concerning issue. This is the explosion of debt. And I took this chart and I added 2 red arrows like I normally do. I just want to point you to them. One is this is the total debt balance. You've got the red is non-housing debt and the blue is housing debt. First of all, it just went over $16 trillion. Now, it's staggering to even think about how much money that is, but $16 trillion is massive. Second, the GFC, that's the global financial crisis. Remember that, everybody? Q1 2008, it hit a peak. So are we heading for another financial crisis? So I put in my little hello world spotted trend. We are way higher than we were back then, and things are just exploding upwards. But there's more. So if you look at how this is broken down, and what I'm very afraid of is delinquencies. So here you can see the GFC again, global financial crisis, all the delinquencies. If you look at the lines, just to call out the colors, the red is student loans. That seems to be the safest place. Auto loans are green. Credit cards are blue. That yellow line is mortgages, and HE is home equity line of credit, revolving credit. You can see the delinquencies on the home equity revolving credit is exploding upwards, credit card is exploding upwards, and auto loans are exploding upwards. The last thing people will stop paying is their mortgage, because they know if they stop paying their mortgage, they could lose their home. That hasn't peaked up like the other 3 yet, but I believe it's only a matter of time before it spikes up. Currently, these are between 6, 5, and 2.5%, and I see them going back up to north of 10% as we go forward. And that is definitely an area of concern as we go forward. And this could bring about a bubble crash that is bad. Again, could be wrong, but this data tells me something is up. And we are seeing a massive, massive consumer credit crunch. So again, I always talk about the Fed being boxed in, and I know the Fed is aware of the stuff I just showed. If they continue to jack rates more, think not only will they reduce US GDP, but they're also going to cripple all those people with mortgages, car loans, credit card debt, etc. Every time it goes up, like mortgage rates just eclipsed 5% again. They went nearly as high as 6%, came down just under 5%, now they're back up again. As every little basis point goes up, it cripples more and more people in their ability to service their debt, as well as the US government, who has more debt than most people as well. $30 trillion worth. So again, they know, and I've never been more confident. People thought I was crazy when I was talking about the Fed being boxed in 3 months ago and they can't raise above 3.5% FFR, federal funds rate. Now I'm absolutely convinced they can't. Because if they look at this number, they know if they jack, not only are they putting themselves in financial Armageddon, are they going to crush GDP, but they'll also crush everybody in the United States. And as other countries around the world follow, they're going to crush them too. So a lot of, we talk about the Fed because a lot of other central banks around the world follow their lead as they go forward. So finally, in terms of Swiss franc euro news, this chart looks pretty darn scary. And whenever I see a chart like this, I feel something's going to break. Obviously, the Swiss franc is a safe haven and the euro is absolutely bleeding against it hard. To go from like $1.70 to down to 96 in a pretty relatively short window of time for a macro scale is stunning. So with that, everybody, let me know if you like the global macro update, if you want to know more. Again, pretty scary stuff, but stuff we need to be aware of and plan around as we go forward. So thank you everybody for being here. Happy Saturday. I nearly forgot what day it was. Sometimes I do that because all my days bleed together. Thanks all. Thanks to the mods. And I'll see you all tomorrow for live Q&A.